So as of Thursday, almost two-thirds of companies have reported on their Q1 earnings, and almost 87-88% of them have basically beaten Wall Street forecasts or estimates of company performance. All of your major companies, your key companies, potentially your most valuable companies from a market capitalization perspective, your Facebook, your Apples, your Amazons, your Google Alphabets, as well as your Microsoft, have absolutely trounced earnings, okay? And you would expect with this significant amount of outperformance that is taking place in these companies, shouldn't there be some more price action when it comes to the major indices? Because if you look at the major indices, i.e. your S&P 500 or your NASDAQ or your Dow, they've been relatively flat for the week if you look at the beginning and the end points. Now granted, there was a significant amount of volatility during the week. According to Refinitiv research, at the rate at which companies were beating estimates and the magnitude by which they were beating expectations through Thursday morning's results were the best on record. Some 87% approximately of S&P 500 companies reporting results beat Wall Street forecasts and are doing so by an average of 23.5%. Both are the largest ever recorded gaps according to Refinitive data, which dates back to 1994. Overall, S&P 500 earnings growth is currently on pace to total 44.7% in the first quarter, which would be the best in over a decade, and yet the market is relatively flat. So why is this happening? And that is the basic question that I wanted to address in this video. By the way, before I get too far into it, don't forget to hit the like button and subscribe to the channel, and let's get into it. Typically, when you do this type of research, right, you'll get some pretty wishy-washy answers, okay, because it's all based on analyst opinions, if you will. What analysts will usually say is that if you have a company that has basically beaten expectations and there's a significant price action movement for that particular stock, what they will say is that, oh, it was not contemplated. There is a significant amount of earnings trajectory. This was a surprise, an earnings surprise, if you will, and that is what's resulting in that stock moving up. Similarly, if you have a company that has beaten expectations, but yet its stock price is not moving, the analysts will typically say is that, oh, it was already factored in. We knew this was going to happen. The stock market is forward-looking, and due to that particular phenomenon, that is why the stock price is not moving up. So they're basically saying both things, right? They're basically saying that, oh, in this particular case, the stock market was not forward-looking. In this particular case, the stock market was forward-looking. But this forward-looking notion is one of the core things that you'll hear about when it comes to why indices do not perform or why a stock price does not perform when it comes to earnings performance or earnings growth. All of these earnings have effectively been contemplated by the stock market multiple quarters ago, and the stock market at this point in time is trying to anticipate what is going to be happening from a company earnings standpoint, potentially 3, 4, or more quarters ahead of us at this point in time. But if you double click into the analysts just a little bit further and ask them the question, well, why are your earnings estimates so far off, right? Shouldn't your earnings estimate, if you knew that this was going to happen all along, be closer to what these actual numbers really are? And to that notion, the typical response that you'll get is, well, companies have stopped providing guidance during this whole global healthcare crisis because companies did not know what their level of performance was going to be. They did not know what the macro environment was basically going to show. So they were these analysts were effectively operating in a bubble, and so when they're operating in a bubble, there's going to be a significant gap between what these actual numbers may potentially turn out relative to what their estimates really were. Wall Street analysts, they do like to provide data, right? But of course, you can provide data in whatever fashion you want. But when it comes to some of these, everything being factored in notion, this particular talk track, what they will typically cite is Apple example, okay? And what they'll say when it comes to Apple's earnings, they'll basically say that, hey, this particular thing is trading 35 times earnings, and then you've added over $1.5 trillion in market capitalization over the last 12 months. And why do you think all of this happened? This was all happening with the notion that this company was basically going to demonstrate this significant amount of outperformance. You can basically show a similar example for a lot of the other tech companies as well, and it's usually a little bit lighter when you get a little bit beyond that and start talking about some of your cyclical type of stocks. Now, there are other experts out there who will provide a slightly different answer, okay? A more hedged response, if you will. It's very hard to take away from this forward-looking notion, right? Because it's usually the stock market is forward-looking. It is an amalgamation of a lot of different things, which has not been potentially contemplated by an individual analyst. But what some of the experts will also say is it's not only just the forward-looking component, there's more to it, and there's a lot of risk factors that are in the marketplace as well. And it's due to these risk factors, the market is having some challenges in terms of contemplating where stocks or earnings performance is basically going to be several quarters from now, and is not essentially rewarding a lot of these stocks until there's some clarification received on some of these risk factors that are out there. So what are these risk factors? Well, when you break it down, there's quite a few of them, okay? So one of the risk factors, for example, is inflation, right? There's this notion by the Fed that it's transitory. There's some buy-in into that transitory fact pattern, but now there's some level of concern that, well, is it actually going to be transitory because commodity prices continue to go up? So maybe there's going to be more to it, as well as there's this notion that wages may potentially be increasing as well, particularly the minimum wage under the current administration. So that's one risk factor. Other people are concerned about, well, what's going to come out with taxes, both on a personal as well as a corporate level, and how will the market basically react to that? And other people will also cite other risk factors, such as, well, there's a lot of confidence in terms of the reopening, if you will, but what will be the change in consumer behavior once things reopen up, right? And this is what's impacting certain stocks, such as Pinterest as well as Twitter. Other people, when it comes to this whole pandemic type of response, will also cite things such as, well, the Western world is doing fairly well in getting past this thing and basically putting it in the rearview mirror, but there's lots of developing countries such as India which have got a significantly different talk track, right? These countries are basically in the throes of this issue at this point in time, so there's some level of lack of clarity, and there may be more variants that come out of this whole crisis, which basically needs to get addressed as well. Brief tangent here while I'm on the topic, right? If you want to donate towards resolving or helping contribute towards resolving the situation in India, I've included some links in the description below. They're all valid and credible sites in terms of making a potential donation, and to definitely go ahead and check that out, and it's definitely for a good cause. Yet another risk factor that you'll hear about is around supply chain, right? You'll hear about semiconductor challenges, and semiconductors is pervasive in just about everything that is out there. But there's other, you can make supply chain even a broader category, right? When it comes to housing starts, when it comes to manufacturing homes, with timber prices going through the roof, copper prices going through the roof, when you have all of these things, it does create more challenges in terms of assessing where the economy may potentially be headed. So when you take into account that, and take into account the forward-looking nature, it creates some level of headwinds when it comes to stock performance, and that's all resulted in some level of sideways behavior when it comes to these major indices. From my perspective, I think the root cause is really just two things. One, there's a significant amount of overvaluation that has taken place, and the second thing that I would basically say is that people are expecting that rates will effectively normalize, so they have a slightly different discount factor that they now need to contemplate, which is what's also resulting in these stock prices basically not moving up. So what can you do in an environment such as this with your own portfolio? Well, perhaps the easiest thing to do by far, right, is maybe not look at this from a day-to-day basis or a week-to-week basis, because that was the chart that I effectively showed at the beginning of this video. I showed a weekly performance chart, but if you look over a broader time horizon, you can see a lot of these indices have been going up for a very extended period of time, and you've realized significant results already. So this is the all true, the buy and hold type of mentality, the mentality that talks about investing in indices. Well, this whole thing sounds really boring and definitely not as exciting as what some other folks talk about, but it is a tried and proven way of effectively realizing consistent returns over a long period of time. Now, if you're one of those individuals like myself who likes to trade in and out of stocks, then one thing that you can do is for the companies that are basically experiencing a significant pullback, even though they're outdoing or outperforming all these estimates, it could even pose a nice little buying opportunity, but with the presumption that you're going to hold on to these stocks and that they're best of breed for an extended period of time. Now, of course, none of this is intended to be financial advice, right? So definitely do your own due diligence. Investing is by far inherently risky, but hopefully this video provides some perspective in terms of why these stocks are essential, or why these indices are not significantly moving up, right? It's really a combination of factors. So if you enjoyed the contents of this this video, definitely like, subscribe, and ring the notification bell, and I'll see you soon.